Well, with the debt ceiling deal finally agreed over the weekend, markets can at long last move on from the political pantomime and focus back on some of the macroeconomic fundamentals that we know and love. Equities continuing to perform well, the S&P 500 notching a third week of gains, while the dollar is also finding a lot of love as the market continues to price out cuts in the second half of the year from the Federal Reserve. A busy week lies ahead for the financial markets. The non-farm payrolls number on Friday, the obvious highlight. We've got plenty in the mix besides that. The latest PMI figures, Eurozone inflation, JOLTS data, and a lot more besides that as well. Plenty as always for us to discuss in the trade-off this week. So without further ado, let's get into the show. Well, mercifully, the debt ceiling drama is finally over, and given the way our two football teams have played over the last few weeks, I think we'll be quite glad that the Premier League season is over as well. Let's bring in my co-host, as always, Ryan Littlestone from Forexplo Live and Forex Analytics. Ryan, good morning. How are you doing, mate?
Yeah, morning, mate. I'm okay. And I see, finally, you want to start talking about the debt ceiling stuff, right when it's all at the end of the road.
Well, because we can now talk about the implications of it and what it means and not the political pantomime. I think I described it last week or the week before to a good friend of mine as like Brexit negotiations on steroids, which is what it felt like for some time. But yeah, I think we can all breathe a sigh of relief that that's behind us.
For a couple of years anyway.
I was going to say, yeah, 1st of January 2025. Mark that in your diary already, as that's when we get to do this drama all over again.
Yeah, make sure we take these slides for that period. We just reuse it.
We should. I think I'll have hair like yours by January 2025 if things carry on as they are. Before I get myself into trouble, let's get on to Topical Thunder. So as Ryan said, I do want to talk about the debt ceiling to kick off the show without getting into the political shenanigans and the deal making and all the rest of it. The long and the short of it is a deal's been agreed. President Biden, House Speaker Kevin McCarthy, they've come to an agreement to raise the debt ceiling until January 2025. So very much kicking the can down the road, as they tend to do with this sort of thing. But I think this is going to pass in the House. This is going to pass in the Senate. We know that. There'll be a lot of political posturing, but the market doesn't need to worry about the US defaulting anymore. I think what the market is now going to start to focus on is the implications of the deal that's been done. And for me, there's two of these, and we touched on these very briefly last week. But now that the deal is done and the ink is almost dry, I want to get into them in a little bit more detail. Now, the first is that government spending is still going to increase, but it's going to increase at a much slower pace and a slower rate than had previously been expected. So what this means is that the US is going to run a marginally tighter fiscal policy than we would have expected had the debt ceiling deal not been agreed. This has two implications. One, it is a modest amount of downward pressure on inflation, although I don't think it's going to move the needle too much. Perhaps more importantly, it is a downside risk to GDP. Bloomberg had a very, very good chart out over the weekend showing that the contribution to US GDP from government spending has been increasing significantly quarter on quarter. Well, that's now not going to happen. So it's a downside risk to growth from that point of view, but also in terms of the tighter policy, it is another downside risk to growth there, as momentum is already showing some signs of starting to wane. And the second implication, and I'll bring you in just one moment, Ryan, is this idea of the Treasury General account, effectively the Treasury's savings account or their current account. The balance in there has got down to 50 odd billion, give or take a few billion. They would probably rather that was sitting around 500 or 600 billion. So there's got to be a huge rebuild in that Treasury General account in order for them to have that buffer that they like to operate with. But how do they do that? They're going to issue a huge amount of Treasury bills, really, really short dated US government debt. What's the implication of that? Well, there's two, really. The first is that it's going to force yields higher at the front end of the curve as the market soaks up all this issuance. The second is that it's going to drain liquidity because investors are going to swap their dollars. They're going to use those dollars to buy Treasury bills. That will take dollars out of the market. And there's three potential results of that. One is it's another headwind for equities to try and worry about. And we know that the very, very tight correlation between liquidity and the equity market. The second is that it's an upside risk for the dollar, because obviously if you have less dollars in the market, that is going to put upward pressure on the currency. And the third, and perhaps this is the one that we should worry about the most, is it's another risk for the banks. Given we know how precarious bank balance sheets are, particularly the regional banks in the US, it is a risk that we should watch very, very closely indeed. So the political side of the debt ceiling is done, but I think the macro side might be just getting underway.
Yeah, I think so. And one thing you have to add to your list there is that they're going to be doing so at much, much higher rates than they have done, previously in the last episode. So it's going to cost them a pretty penny. But we have been here before. They have done this drawdown of the TGA, use the cash. I think back in 2011. So I think the market is going to be jumping all over this, but probably in a few weeks' time, it will just forget about it. And we'll move on, and it'll just become part of the everyday noise that we see. But you're right, if we start to see things like liquidity issues, particularly with the dollar, and it always rears its head, dollar shortages, around the globe, and this country's suddenly short dollars, and, we hear that from time to time, then it could put a little bit of funk in the markets. But yeah, I think it's going to be a long drawn out process, because it's the TGA isn't just made up of obviously what they get from bond sales. It's tax collections. It's what they do on that side of things. There's the COVID program. They've still got funds there that they can roll back in. So it's another game of accounting smoke and mirrors, and it's up to the market to decide what it wants to do with that.
No, absolutely. And just lastly, on that point, and this has just come into my head, you mentioning dollar shortages. It was probably, 4 weeks ago, all of those dollar swap lines went back to weekly from daily. Yeah. So that's another thing worth bearing in mind. Not that I'm suggesting that there are going to be funding pressures, but it's just another potential thing to have on the radar over the longer term. But in terms of the short term, it's a busy week ahead, isn't it?
Yeah, very busy week ahead. This is one of those times of the month where we get all the big data coming out in a big long slate. And so what I will do is just pick out some of those key data points to look at this week. And you mentioned some in the intro. So obviously everything's going to culminate in the NFPs on Friday, but we kick things off today with US consumer confidence, and we're going to be watching those inflation numbers again. Now, the headline in the Michigan dropped a good chunk. We got the final numbers on Friday, and they dropped a bit as well. And also the CPI pulled back. CPI on the 1 year number, it gave back a lot of the gain. It made a 100 pip gain, I think it was in April. Gave back a few pips of that, although the 5 year number continues to rise modestly. So in the consumer confidence number, we get 1 year and longer term inflation expectations there. Keep an eye on those because they're important for the Fed, obviously, and what the consumer thinks about prices. On Wednesday, we do have jolts, and it's been trending lower the last few months or so. It seemed to top in February, which would have been December's data. So now we're going to see if that continues, if it's closing that gap, that ratio between how many unemployed and how many jobs on offer. Again, that signifies maybe a bit of a tightening market, as well as perhaps showing that firms are not so willing to or haven't got the spaces now to advertise for jobs. So it's a little bit one of those numbers you've got to look at the finer details, look at things like quits, because that tends to tell you if people are trading up jobs, so they've got confidence that they can move up the jobs ladder. So that's something to keep an eye on Wednesday. Thursday, as you mentioned, Eurozone CPI, the flash numbers for May. So all goes into the ECB pot. Are we going to see inflation continuing to come down, or are we going to get this same stickiness we've seen elsewhere? What's that going to do for hike expectations for June and the following months to come? We've also got the start of the jobs data for the US. We have Challenger Gray layoffs, which tells us firms who are looking to lay people off. Doesn't necessarily mean that they actually end up in redundancies, but we've seen from the tech industry, all those big layoffs, they filter through into this data point, the Challenger Gray numbers. And then obviously we get, let's call it the ADP, the NFP practice via the ADP report. Which
the ADP need a lot of practice, to be fair.
Exactly. And so that gives us a bit of a heads up into the NFP. It's never a one-to-one ratio between those two, but if there's a big variation, it gets the market a little bit fluttery ahead of the NFP. And then obviously we get the big ISM PMIs for manufacturing. Again, looking at the jobs numbers, prices paid, activity overall. We know globally the manufacturing PMIs have been a little bit on the weak side. A lot of Europe in contraction. Are we going to see the same in the US continuing? That split between manufacturing and services, which have been much stronger. And then obviously NFP on Friday, which as we know is always a fun and games and a bit of a lottery. So we look forward to that one. And so I wanted to know from you, Michael, what's your highlight of the week?
Oh, blimey, there we go. That's a $1 million question, isn't it? I think that it gets more important as the week goes on. Today's interesting. Tuesday, Wednesday, jolts is worth a look. Thursday, the Eurozone inflation number is absolutely key. A few of the more hawkish members of the governing council at the ECB are starting to put September on the table as well in terms of hiking into the autumn. So if we get a hot, particularly core CPI number, that's what I'll be watching there. But I think for me, the highlight is the non-farm payrolls number. Yes, you can argue that there's quirks in the data. Yes, you can argue it's not as big a market mover as it perhaps used to be. But at the end of the day, the question that everyone has been asking for some time now, probably 12 to 18 months, is when is the labour market going to start to roll over? And every non-farm payrolls number that we get seems to delay the answer to that question for another 2 or 3 months. We've had 13 consecutive upside surprises on the headline payrolls number now. I think there's a decent chance we could get 14 this week. There really is no sign that the jobs market is softening in a significant way just yet. So, yeah, non-farm payrolls is my highlight of the week. And
can I wheedle out a guess from you early doors?
Not yet. Let's have the jolts. Let's have the jobless claims. Let's have the ISM number, and we'll put it all into the little supercomputer and the models, and we'll see what random number gets thrown out of it at the end.
One day, you to put it out.
But I will be entering, and I advise everyone to do so, the Forex Analytics sweepstake. It will be on Ryan's Twitter feed at some point as the week goes on. Let's get on to the UK. God, where the hell do we start with the UK? Last week was just a catastrophe, to be honest. I mean, the news on inflation gets worse and worse. I guess the glimmer of hope, and the media here have been running with this, is that headline inflation fell from 10-ish% to 8.7% in the month of April. Well, yeah, that's right, but headline inflation at 8.7 compared to an expectation of 8.2 when the fall was driven entirely by the base effects of surging energy prices last year isn't exactly good news. So I'm not entirely sure why the media have been spinning it as such. Even worse than that is when you look at the core inflation number. So you take out food, you take out energy, core inflation was 6.8% year on year in April. That is above the 6.2% we expected, and the 6.2% prior. It's a 30-year high on the core inflation print, going all the way back to 1993. And there's really no good news in there at all. And I think we can safely say that stagflation has well and truly arrived in the UK. We've seen markets reprice their BOE outlook in a hawkish direction as a result. We now see the 2-year yield at its highest since Liz Truss was Prime Minister for about 50 days. The 2-year sits at about 4.5% this morning, although it must be said there's a very different reason for it being there now than there was when Truss and Kwarteng were running the show. And then if you look at the OIS market, the rates pricing for the UK, the market now expects bank rate to be raised in June, August, September, and November. So that has a terminal rate at about 5.5%, meaning that I probably now very embarrassingly need to row back on my prediction that 5% was punchy, because I think 5% probably isn't going to be enough at this point, given what we see in terms of the inflation dynamics here in the UK. But I think it's worth mentioning, and I put this out on Twitter last week, that the BOE are stuck in a mess of their own making between a rock and a very, very hard place. Because as I see it, and Ryan, I'm keen to get your view on this, they've got 3 options. They either do nothing on rates, and you just see this inflation problem embed itself and get worse. They do a little bit on rates, as they've previously indicated, maybe one or two more hikes, and it has no real impact on inflation, a modest downside hit to growth, and we're still in a pretty bad situation. Or they do a lot more in terms of rate hikes, a lot more tightening. They get rates to where the market price is, which probably will get inflation under some sort of control, but it's also going to absolutely destroy the demand side of the economy. So I've been bearish on the pound for a while, but I think the way that sterling has detached from rate spreads last week is a sign that the market, for me, is waking up to the idea that stagflation has arrived. BOE hikes are not going to be supportive of the economy. They're not going to be supportive of the pound. And I really can see cable falling towards the 120 mark over the near term and the medium term as well.
Yeah, and this is going to sound strange, but I do have a bit of sympathy for the Bank of England on one hand, because
Get him off the show. Who invited him in?
and that's because, their rate setting is very ineffective against inflation. Always has been. They could raise rates to 10%. It wouldn't have a jot of difference on these inflation numbers that we were coming up. It's going to happen. They have to let it pass through. They have to let it do what it wants to do, because a hell of a lot of this inflation is imported. And you can't do anything about it. Rates can't do anything about that. Even if you collapse your domestic economy by high interest rates, it's still going to cost the same amount to fill up your car with petrol. So, on that side, I've got some sympathy. What sympathy I don't have for them is the way they've gone about it. They put themselves in a corner, by being pretty dovish all the way through this. They should have done what the ECB did, done what the Fed have done, and said, right, we're going to sort this out. We're going to need to raise rates higher. Here's where we think we're going to have to get them to, and put in a bit of a ceiling and say, but we're not going to be, held to that. If we have to go higher than that, then we need to. But all the way through this, when rates were, getting up to 3.25%, it's all, well, we don't know how many more we're going to have to do. We don't want to get rates higher. Bailey talking about, he hopes that we don't have to raise any more. That sort of guff is ridiculous, and that's what does the damage. But as you say, we might not be going as high as 5%. We might even be going higher, which again won't be a surprise to me, because I saw this coming months and months ago, as you well know. But the reaction in the pound is interesting, because we're not seeing the pound gain significantly against the dollar, at least. We're seeing a little bit of movement in euro sterling, because we're going to have that that rate difference potentially now between the BOE and the ECB. But yeah, in the short term, the pound is obviously, particularly cable, trading mostly on the dollar side of things and what's been happening in the US. But they're going to be forced higher, and they're going to have to deal with it, I'm afraid.
Absolutely. All fun and games here in the UK, isn't it? What about Norway, the Norges Bank? It's an interesting one, actually. They're doing some interesting things. It's not getting enough attention, so I'm glad you brought it up this morning.
Yeah, definitely. And just to give a little bit of insight in what the Norges Bank do, is that they sell not krona on behalf of the government, and this is all the taxes and the profits from all the oil sales and everything, and they receive the NOK from these tax payments, and they have to exchange it for foreign currencies that are used for investments in their big state oil fund. Now, tomorrow we get the latest update from the Norges Bank of what they're going to be doing for FX. So usually every month they say we're going to be selling X amount of krona each week or each month. And because it's running with about a 6-month lag, these tax payments, so we're just sort of finishing off 2022 tax payments, and we're going to be setting up for the 2023 tax payments. Now, obviously, the price of oil has been much lower since in 2022. So those tax payments are expected to come in a lot lower. That means that the tax receipts are going to be a lot lower, and they're not going to have as much NOK to sell. Now, there's some in the market who are saying that perhaps they're going to stop selling altogether because there's potentially not enough. I'm not sure that's going to happen, but we have to wait and see. That report comes out tomorrow. Now, NOK pairs in general have been on a real rip of late, and this may take some of the heat out. It doesn't mean they're going to reverse entirely and we're going to see NOK pairs suddenly dropping, but if we're going to see some of that heat coming out of the reasons why it's been rallying, these pairs have been rallying, then maybe we're going to see a bit of downside on that, which I'm going to look at the charts in a bit later. They're also keeping their rates in pretty much in step with the ECB. They're currently at 3.25%, expected to hike again in June. So they're going to go, blow for blow what the ECB doing. So this is going to be one that's going to be interesting to watch tomorrow. Keep an eye on that report, and if you trade the NOK, then this is going to be an important one.
Yeah, absolutely. I mean, I think I brought up the NOK as a play of the day probably about 2-3 months ago now, one of the very early shows that we did. And one of the reasons why that play didn't work was because despite the NOK having a lot going for it at the time, crude was rallying, equities were rallying, etc., was this selling from the Norges Bank? And, the famous phrase, don't fight the Fed. I think it applies to every central bank. Don't fight any of them. If they are going in one direction, ride that wave with them. And I think it is going to be very, very interesting to see what they have to say in this report. Because as you rightly say, if they are going to be reducing their NOK sales, then that is potentially a catalyst for the tide to turn. But I'm not going to steal your thunder because I know you want to get onto that a bit later on. So without further ado, let's get into That's a Setup. So the first thing I want to look at this week is the 2-year Treasury yield, actually. Now, I've got to caveat this first. One, everyone knows that I'm not the biggest fan of technical analysis the world has ever seen, and certainly not when it comes to Treasury yields. But I'm under captain's orders to put some lines on the chart, so there you go. I think the most interesting thing about this is the speed at which we've seen the market move. Now, the 2-year has sold off by 75 basis points over the month of May. There's obviously a couple of reasons for that. We've had the nerves over the debt ceiling, which have been pressuring treasuries quite significantly. But we've also had this big hawkish repricing of the Fed outlook. Now, just to put that into a bit of context, when we sat down to do the show last week, the market was pricing about 40 basis points worth of cuts from the Fed between now and the end of the year. I checked this morning, the market's now pricing at about 7 basis points worth of cuts. That was 10 times as much just a month ago towards the tail end of April, beginning of May. So it's a big, big move that the market has taken to price out those cuts from the Fed. And I think when you look at the 2-year yield, we're back north of 4.5%. Now, this chart only goes back to last autumn, but if you go back a little bit further than that, 4.5% has been this kind of key line in the sand between the bulls and the bears for quite some time to come. So I think that we could see treasuries continue to move higher. The market has priced out cuts this year, but it still has a few in the curve for early next year, which do have room to price out. Of course, you've got that treasury issuance to come in that I mentioned earlier as well. So I think we could see yields continuing to sell off and move higher. If we do, then that is an upside risk for the dollar. And of course, it's another block in that wall of worry that equities are ably climbing at the moment.
Yeah, and we've been looking at the 2-year quite often on this show. I think it was one of my plays of the day back in April. You can see where we had that big drop from up to 5% and then the bounce to 4.26%. That was a level to look at there. We've broke through that, as you say. And you're right, it's been difficult to ascertain what this has been moving on. Have yields been rising purely on the debt ceiling stuff because investors demanding higher premiums? And what's going to happen now? Are we going to see a bit of a relief coming in now that the deal's done, and perhaps we see yields coming off the next couple of sessions maybe? Or are they going to continue higher because they've got to refill the TGA? They're going to be issuing more bonds, that sort of thing. So it's going to be interesting here. And on the other side, you look at the shorter end, the 1 years, the 2 years, to see those expectations for the higher for longer calls from the Fed. This is where it's priced. If you start seeing the yields coming down here significantly, that's the market saying, well, that higher for longer isn't going to be perhaps as long as the Fed are telling us. And we're going to get that play between what the Fed are going to say and what the market's going to judge back for those cuts again. And that's all going to come on the data. But yeah, the 2-year yield's moving back up, still quite a way below where the Fed funds rate, the midpoint is for that. So it has got some room to roam if that higher for longer is going to be believed by the market.
Yeah, absolutely. I was going to make very final point on this chart. The midpoint of the Fed funds rate is roughly where that red line is, the high from February, which is about 5.15%. So if the market does fully buy into higher for longer, another 50 odd basis points to go. What about the euro, Ryan?
Yeah, big level on the euro. We've just broken it this morning. I had to do a quick bit of rewriting of my analysis for this one. But yeah, we've got big support here at 107. It's one of those real big levels, as you can see from the chart there. We had a bit of a zone that we were walking between 105 and 107 before we got that break higher. And this could be a real make or break level here at 107. What we've also done, we've also broken the second phase of the big rally from last September. As you can see there, the fibs, which are coming up from the March leg higher. We've broken through all the fibs there. So we've definitely got a turn in the trend, but we've got a long way to go until we hit sort of the first fibs of the rally since September, down coming in round about that 105 area, which is another huge area going back all the way to 2003. So a real big level to watch here. So if we break and hold this break of 107, then I should think we're going to get a move down towards that 105. As I said, that's another huge support level. Now, last week, my play of the day was buying off the 107.60 area, which triggered, and I managed to get a few pips out of it before it came back down, and I got stopped out at break even +1, as I like to do. Always like to nick a pip if I can. But that break has become resistance now. So 107.60. If we hold the 107, get back above, that's the first resistance area to look at. Then it's 108, 108.30, some of the old levels up to that blue zone you can see there. But as I say, if we hold this break, then I think we could be on for a test of 105.
Yeah, I tend to agree with you here. I mean, it's a real turnaround in fortunes for the euro. It feels like, 6-8 weeks ago that we were talking about potentially 115 in euro dollar. And I think perhaps the more worrying thing for me from a fundamental point of view is, as I alluded to earlier, ECB speakers have been relatively hawkish. Even some of the more dovish members of the governing council are talking about potentially having to hike beyond July, being a long way from the tightening cycle being over. And the euro just hasn't rallied. And as the old saying goes, if an asset can't rally on news that should make it rally, there's really only one way that it can go. And as you rightly say, that 105 level has been a huge historical kind of pivot for euro dollar. Above it, and the bulls are in control below it, and the bears have command of things. And I think it does look like we could be gunning for a test of that. Of course, the key comes Thursday and Friday. What do we get on the inflation number? What do we get on the payrolls print? If we get a downside surprise, a cooler than expected inflation number, and a hot non-farm payrolls print, that could be the catalyst to unlock some further downside there.
Yeah, most definitely. And it's, we spoke about this in previous shows. We came through that week of having all the big central banks coming out, and pretty much the currencies dropped after every single one. Bank of England, another hike, and saying they're going to have to potentially do more, and the pound's lower. The euro, we've got up to 111. The ECB, we're going to have to hike more, and we're lower. You can see it for the RBNZ, the RBA. Doesn't matter what central bank. At the moment, the dollar is the game in town after all these central bank events. So the ECB can be as hawkish as they like, but for the moment, the market, I think, is going to sell when the euro rallies.
Absolutely. Buy dollars, wear diamonds, as they say. Or buy tech, wear diamonds. Let's have a look at the Nasdaq, because that seems to be what's going on at the moment. Tech is certainly the sort of shining star of the stock market at the moment. The Nasdaq having a storming week last week. The tech sector is still finding an awful lot of love. And of course, Nvidia, which is the third biggest constituent of the Nasdaq, with that very, very strong forward guidance in their earnings last week, was obviously a big help. Just on Nvidia, I think the move there is absolutely ridiculous. It does look a bit bubbly, but I think you'd be mental to short it. That is proper kind of picking up pennies in front of a steamroller stuff if you were looking to fade that move. Anyway, back to the Nasdaq. We're at the highest level since April of last year. We're testing 14,500, and really it's hard to bet against the tech sector at the moment. The bulls have a lot going for them. They're shrugging off this hawkish repricing that we've seen in terms terms of Fed policy. The debt deal is likely to help give risk a bit of a lift as well. And again, if you're worried about narrow breadth in the equity market, where are the gains coming from? They're coming from the tech sector. I think if we get a closing break above 14,500, it's only going to embolden the bulls even further. And personally, I've been saying it for a while, I still like being long risk. I still like being long tech. And if we get any dips into the kind of 14,000, 13,900, 13,800-ish level, then I'd be looking to buy on those as well.
Yeah, and I'm sure you're an expert in this field, but talking about things that may be bubbly, how much of this do you think is being driven by all this AI mania that we've got at the moment?
Well, I struggle to turn a computer on some mornings, and as Kyriakos will know, it takes me about 15 minutes to set up a camera. So I think expert may be overdoing it a little bit. I think there's a lot of frenzy around the AI stuff at the moment. You can't deny that. But also there's a lot of stuff in the index that isn't AI related that's doing well, and also in the S&P as well. So I don't think you can claim that the entire move is based on AI. But having said that, we could probably do with a bit of consolidation just to take a bit of froth out. But I think the medium-term bias is still to the upside for me.
Well, I think after the show, I'm actually going to ask Chatbot to see if he's got a different answer to yours, mate, and see what he's got to say for it. We might get him on the show next week.
Well, I was going to say, it could be an upgrade. What about something that isn't AI and is very old school, WTI crude?
Yeah, looking at US oil, and, it's one of the assets I think might benefit from a bit of a risk-on mood if over this debt ceiling stuff, and because it has been really, really suppressed, and you've got some circles saying that a default and a shutdown is going to lead to maybe some less use of oil. So this might be one that sees a little bit of a risk bounce. We saw a little bit last night on the open when the market started digesting the debt ceiling news. We've also got Biden wanting to get back into oil trading. Maybe he didn't have the funds because they were running short to replenish the SPR. So now they've raised the ceiling. He might have
is he not allowed to trade on leverage, Joe Biden?
He could probably trade. Well, I'd like to see him on a trading platform anyway.
You think I'm bad with computers?
I think he's got better techers than you, mate, though. I would.
Probably.
So, yeah, I mean, we've got this $70 level down here, which is a bit of a marker, a bit of a pivot. We've had moves under that. They haven't held. And that, to me, is quite significant. So I wouldn't be surprised if the bottom pickers start getting a bit encouraged that we can't break through that 70 area. And as I say, if we get a bit of a risk bounce over the next couple of sessions, then we could be heading higher for oil, maybe up to that $80 mark, maybe at a real big push up to that 82.50, which has been a real solid level up there. If we don't, though, if there's no reaction over the next couple of sessions, then we're stuck in this same sort of confusion about what the true direction for oil is. And that's got to be something that's a bit concerning, because this is probably one of the longest periods of consolidation we've seen for a long while. So the market really doesn't know what to do with this at the moment.
No, I think you're right. It has been a very, very prolonged period of effectively going nowhere. But if we do see a bit of a rally off this $70 mark, then good news for the NOK, which I know you're going to get onto in a second. So why don't we move on to our plays of the day? So I want to look at gold this week. Last week's play of the day actually worked quite well, selling the pound on a break below the 50-day moving average, and was slightly more profitable than your one pip trade, Ryan. So do allow me to take.
Hey, come on! I made a few pips. I made about 25 pips off of it.
There we go. Sorry, I was slightly uncharitable to you. Anyway, let's have a look at gold, because we're at a huge level here, and I've got my crayons out and gone all the way back to this is a couple of years now on the chart. And you can see this 2075 level has been huge resistance for the yellow metal. I mean, you could perhaps even call it a triple top if you really wanted to. And again, we've backed away from that level. There's not really a lot going for gold at the moment, if we're being honest. You've got real yields moving quite sharply higher, nominal yields moving quite sharply higher as well. Risk appetite's pretty firm, as you can see by the performance of the Nasdaq that we showed a moment ago. The S&P rallying, European equities doing okay as well. And of course, the dollar is really the kind of loved currency in the G10 universe at the moment, and that's bad news for gold as well. We're at a huge level, this 1935 reason. We've got a trend line in here from the back end of 2022. We've also got the 100-day moving average here as well. So if we get a closing break of 1,935, I'd be looking to sell gold down to around the 1850 region where you've got horizontal support. But you've also got the 200-day moving average lurking there as well. Of course, if we do get a downside surprise in the payrolls number, we could see treasuries rally, which could put a bit of life back into the gold price. But if we manage to hold that trend line on a retest, then I'd be more than happy staying in that short position. It feels like we've mentioned this about a million times today, but what about the Norwegian kroner again?
Yeah. Well, keeping it topical, and EURNOK is the one I'm looking at as my play of the day today. I've actually jumped into a bit of a short last night. Really, this is what I feel is a really good risk-reward trade. We've got a big solid level up here. We made a high around this sort of 1191, 92 area. We've tested it again as we came in to trading this week, and it's holding for now. So I've playing a short off of this tech up here at 1190. You can keep it fairly tight, as I say, good risk reward. Stop on mine is at 95.75. Just trying to keep it a bit out the woods, as we like to say. And if we do get the Norges Bank given a bit of impetus for knock buyers, then if we do get a move down, this could yield some decent money. And so I'm going to look to around about the 1185 area. If we get down there to start taking some profit on that. If we get down there, then looking at 1168, 70, then the next level's below. If I see that, then I'm going to start bringing my stop down to well under entry and try and lock in the rest and just see where it goes from here. But off the top there, you don't need to give it a lot of room. If the level breaks, we're obviously potentially going higher. So as I say, good risk reward up here.
Yeah, I would agree. And we'll see if the Norges Bank give you a bit of a helping hand. One thing that I should have mentioned but didn't, the Swedish krona, absolutely battered at the moment. I think Euro SEK is at its lowest since 2009. So interesting that the NOK and the SEK are starting to head in different directions when they usually tend to move in tandem with each other. But perhaps that is one we can add to the list to discuss next week. Because that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live on Forex Analytics for joining us. Thank you also to our producer, Kyriakos, for bringing this together so brilliantly, as he always does. All three of us we'll be back again this time next week. If you enjoyed the show, please drop a like on the video, leave a comment, let us know how you're trading the markets, and we'll be back again to do it in a week's time. Thanks as always, and goodbye for now.